Hello guys, welcome back to my YouTube channel. So today I'm going to be helping you identify areas of liquidity. So there's different types of liquidity, and the way I normally trade is I trade towards liquidity. So whenever you're trading, you should always wait for manipulation to happen in the markets. And in order to know that manipulation is taking place, you need to know the patterns that take place before manipulation is going to happen, or you need to know where liquidity lies. So, first of all, what is liquidity? Liquidity, this is where you set your stop loss. Where you set your stop loss, this is where areas of liquidity is found. For example, if you find where you see equal highs, so what are equal highs? If you see areas like this, usually this represents liquidity on either side. So we have the buy side liquidity and we have the sell side liquidity. So what happens? You always need to wait for market to manipulate, or the banks to manipulate, before you can actually enter a trade. So we've got this example right here. So as a profitable trader, what would you do? You would wait for manipulation to happen on either sides, right? So if manipulation happens on the buy side liquidity and the buy side liquidity is swept, what happens? It means that this liquidity has been taken out, and this will give you a confirmation that market will distribute to the opposite side of the liquidity, which is this area. So you would set your short positions in this area right after the liquidity sweep, setting your stop loss on the above high and your target through to the next area of liquidity. So for you not to overcomplicate this, you need to understand that there are different types of liquidity. So this is liquidity that can be spotted on the equal highs. What if it's a market trend? What if market is trending? How do you identify liquidity? So let's say we are going in a downtrend, right? So this is our downtrend, and market is making lower highs and lower lows. So this is our trend line right here. And what does this represent? We've got liquidity on either side, on both sides, right? We've got liquidity on the upside and the downside. So what you need to first do is mark out this area as area of liquidity. And then you need to mark out this downside area as area of liquidity as well. So as you can see, liquidity and stop losses have been accumulated throughout this whole trend. What you need to do is, if you see a liquidity sweep to the downside, because liquidity is literally a magnet, the market will be pulled to these areas of liquidity because the banks are trying to make money from your stop losses. So wherever you set your stop loss, that is where they are looking to push the market to. So let's say you entered in this trade and you're like, I'm going to sell from this point, and my stop loss is going to be here in this area, and it's going to short down up to this area. So you think, okay, I've made money off of this trade, and yeah, I'm gonna hold further so that market goes down like this. So this is the speculation of a normal trader. But what usually happens is completely different. Market will manipulate, go and shift this liquidity, this trend line liquidity. So all the money that was accumulated in this whole trend will be swept in this area right here. It means we could experience two types of changes. This could be a change of character to the upside, because whenever you see market break a high in a downtrend, this could mean that now we're experiencing a change of character. So what would happen next? We would expect a retest back here, and we would see something like this. How to identify liquidity on wicks? So it's very easy. I'm going to give you an example shortly. So we've got this area right here, right? And we've got this high right here. And we've got this low right here. What do you think when you look at it? When you look at this, what do you think? Or it's just a random move to the upside and downwards? No, it's not. And after that, we can see market consolidating in this area. So I would like you to ignore this move because this will be exemplary to what I'm explaining. So whenever you see market consolidating in an area of liquidity, what does this mean? You should always first mark out the area first. So we've got this area, we mark it out as liquidity, and we've got this area as well to mark it out as liquidity as well. Whenever you're trading, you need to trade towards liquidity or trade after liquidity, because whenever you don't wait for liquidity to get swept first or trade towards it, then you're going to face a lot of problems because your trades will end up getting taken out before you even actually make the profits. So you always need to trade towards liquidity, and or else if you're not trading towards liquidity, you should always trade after the liquidity sweep. So what will happen next? We have this area right here and we have this consolidation. So price was attracted to this area of liquidity because we saw buying momentum through this candle, and it basically broke the range, showing that they are going to take out this area of liquidity right here, and it did as it should have. Now, what if they are going to take out this area of liquidity? It's also the same thing. Once you see a bearish momentum, you would wait for a retest, or sometimes it doesn't happen. You just wait for a retest on this area, targeting this area of liquidity. So you would set your short positions right here, targeting this area of liquidity. So this strategy will help you to trade towards liquidity, not trade in the liquidity. Why? Because whenever you trade in a consolidation, you are most likely going to get taken out. Why? Because these consolidations are areas of equal highs and equal lows, which means liquidity will be on either side. So you always have to be cautious not to take trades in a consolidation. Always take trades after liquidity or trade towards liquidity. If you want to find the liquidity, it's very simple. You need to think as a beginner. If you want to trade as a professional, think like a beginner. Where would you set your stop loss? Don't set it there. Set it in the opposite direction. Why? Because market is going to manipulate, because it knows where the beginners set their stop losses, and it's going to take them out first so that it makes the money to accumulate and move to the other side. So make sure to stay cautious. If you like this video and you manage to get something out of it, make sure to like and make sure to subscribe, because I'm going to be making a lot of these videos very soon. So yeah,